The precious metals narrative is, I think, pretty sustainable over the next 5 years.
Are you bullish on silver? Are you more bullish on silver than gold?
It's a complicated one. I'm pretty sure China has more gold than they're saying. It's the sector with the most price dispersion of any sector, I think, on the planet. Companies like Regius, Westgold. On the Canadian front, we've had big positions in Alamos, in Torex, in Kinross. US front, Kerr Mining has been a big position for us. We were big holders of Silvercrest and Gatos. I'd rather have a mediocre asset geologically and a brilliant management team than a brilliant asset and a mediocre management team. We have some uranium exposure. We tend in our funds we tend not to own the large cap stuff, so we don't own Freeport, we don't own Antofagasta, we don't own Southern Copper.
Mr. David Finch, sir, thank you so much for being here.
No, it's a pleasure.
Pleasure is all mine, and I'm very much looking forward to this conversation because, well, obviously because you're an overall great guy, but also because Ixios Asset Management manages, or well, you manage over 300 million euros with it, which is almost half a billion Arctic pesos, as I like calling them, and it's all mining focused. There's base metals, there's precious metals in there, and that actually might be a good place to start. How? I mean, how is that? Because that is a lot of money. How is that money deployed? What's the breakdown in percentage terms on a per commodity basis?
Yeah, so it's in fact it's three separate funds. So we have a fund called Ixios Gold, which is precious metals. It does some silver as well. That's about 200. And then we have two other funds in the mining space. One is called Energy Metals, and that does kind of most of the base metals. We don't do iron ore. We don't really do aluminium, and we don't do met coal or thermal coal in there. But we do most of the other metals. And then we have another fund which is quite small, which we launched recently, which is a pure copper mining and exploration fund. So it's about 2/3 precious, 1/3 base metals.
How come? Why is the vast majority in precious metals? Is that a strategic decision? Is it how the
But they're
clients want it?
separate funds, right? So they're mutual funds. So it kind of depends on what investors want to invest in. And yeah, we've the gold fund's been going longer than the energy metals fund. It's been going for 5.5 years now. The energy metals fund's been going for about 3.5. And I think in most of the clients in our funds are European investors, and a lot of them out of Switzerland. And I think there's just those guys are a bit more comfortable with the precious metals story as a long-term investment than they are with the more cyclical nature of energy metals, where you tend to get some pretty exciting boom and bust cycles, which maybe they're not as comfortable with as they are with the precious metals story.
Especially given that the bust part of that cycle always seems to take it 10 times as longer as the boom part of it.
Yeah, it's
Uh,
more volatile on the downside than on the upside, that's for sure.
it
Yeah.
is. It's interesting. I actually went when I met you in Switzerland at the SMI conference. I went on the streets of Zurich asking people on the streets if they invest in gold, and most people don't. Like most regular folks don't invest in gold. So that's interesting to hear that you have a lot of people from Switzerland. Again, I only asked a very
Yeah.
small group of
It's
people.
mainly family offices, private wealth managers, private banks, those kind of guys who are managing kind of large sums for families or individuals.
How would you do it if hypothetically all this money, like all the money that Ixios manages was your money and you could deploy it as you wish? Would you still keep that much money in mining? And if it were mining, how would you deploy it between the different metals?
Yeah, it's kind of, I guess I would, because I've been doing this for a while now, and it's the thing that I kind of know about most. I don't know much about tech or chemicals or in any other sector, so I guess I would. keep it in mining, and I think the precious metals narrative is, I think, pretty sustainable over the next 5 years, and we can talk about that. So I don't think my own allocation, if it was my money, would be very different from what we have at the moment, actually.
Well, let's do talk about that, about why you think the precious metals narrative is looking good. I think they had a tweet recently that post on X that I liked. And surprisingly, it didn't get as much attention, but I think it's a very important piece of information that not many people are talking about. But you said, and I quote, gold used to be quite closely negatively correlated with U.S. real yields, that being the tips, until the US and the EU sanctioned Russian reserves invested in US and Euro government bonds, unquote. Where is that part of your narrative that you say I'm bullish on precious metals over the next 5 years? Is that part of that narrative?
Yeah, I think there's a reason for that deconnection with US real yields. And I think that's the actions which the US and the EU took to sanction Russian reserves. I saw yesterday the EU is now advancing plans to definitively confiscate those reserves. And I think that started a kind of debate, which was resolved pretty quickly among central banks about actually the nature of reserves and what actually constitutes a reserve. And normally, reserves are something you can dip into in times of crisis, right? like war. And when you see Russian reserves being confiscated because the issuers of the bonds that they're invested in don't approve of what they're doing, then, well, that's no longer a reserve. And luckily for Russia, they had a lot of money already in gold in their reserves. But I think a lot of central banks, particularly in the non-aligned world, have had a good think about where they need to have their reserves invested. And as we know, if you have your reserves in gold and you've got them in vaults in your own country, nobody can take them away from you unless they invade your country, right? And gold still is a monetary metal, so I'm sure Russia's been financing a lot of the Ukraine war by shipping its gold to China or India in exchange for whatever they need to pursue the war. And obviously, their US treasuries and their European government bonds are frozen, so they can't use those. And it's interesting when you look. I mean, you see the World Gold Council's regular announcements of central banks who are buying gold, and obviously China and India have been significant buyers, but you've also seen countries which are more or less aligned with the US be big buyers of gold, right? So you had a big purchase from Singapore, big purchase from Saudi Arabia, a big purchase from countries like Poland and the Czech Republic. So I think it's a generalized movement in emerging and developing countries to switch reserves into gold. And when you look, the US, France, Germany, Italy have got between 60 and 70% of their reserves in gold. China nominally is at 5. I think India is at 7. So they're a long, long way below where developed countries are. And I think this recomposition of central bank reserves away from debt instruments towards physical monetary metals is a decade-long process. And it's not something that you can just give an instruction to the trading desk and get done, because the size concerned is very substantial. And I think for China still to have whatever they've got, $750 billion invested in US treasuries, it doesn't make a lot of sense, particularly in a geopolitical environment where tensions are rising between China and the US. So yeah, I think that there's a strong underlying current of buying coming from central banks. It's not particularly price sensitive, I didn't think. It's more strategic, and I think that provides strong long-term support for precious metals prices.
That is actually one of your follow-up tweets to that initial post. It says, quote, since then, a much better inverse correlation has emerged, dot, 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 wait for the suspense, to Chinese 10-year yields. And it's almost perfect. It's almost a
Yeah,
perfect correlation.
and that's natural because Asia is the big buyer, right? So U.S. institutions have almost no weighting in gold. I mean, if you've got a pension with CalPERS or one of these guys, they've got no gold, right? So it's not as if when U.S. rates go up that they're selling gold to buy bonds because they don't have any gold. And the big buyers this year and last year have been not just Chinese official institutions, and there's been big buying from individuals. And when you look at Chinese household balance sheets now, they're net cash. So the Chinese have got a ton of cash. Their traditional kind of investments have been real estate, which has not done very well over the past 5 years, as we all know, and they've already got a lot of it. Chinese stock market, relatively small part, but that's not been great either. Um, uh, Structured interest rate products offering less and less yield. I mean, the yield on the Chinese 10-year now is more like 170 basis points. So even if you have that in a leverage product, it's not that attractive. And the fourth pool traditionally has been gold. And I think that's been the kind of default choice. And so there is actually a relationship between Chinese interest rates and demand for gold. It's not purely a theoretical thing.
Mm.
And yeah, I think the more, and that's been a trend for the past 5 years, the more the gold market or gold demand shifts from west to east, the more Asian kind of fundamental drivers are going to be important, and the less important, what happens to the US in terms of inflation and interest rates, I think.
It is that long term that you're mentioning there that I want to talk about because it's something I've been thinking about. I see all these, I see the news. There was recently an article, I don't remember where I read it, but Goldman Sachs essentially said that China is secretly buying 10 times more gold than officially reported. And again, it's up for interpretation. I suppose you only have the numbers that you can see officially. But what I'm thinking about is that shift that is happening, is this a permanent shift in global reserve dynamics, or is it just a hedge against temporary geopolitical risks because they have risen as well with the gold price?
Yeah. Well, I think the first thing to say about that is, yes, I'm pretty sure China has more gold than they're saying. At LME week, I talked to some bullion dealers in London. We were in the middle of that period where the Chinese central bank had stopped announcing any gold purchases, and their feedback was that Chinese commercial banks had continued to be very present in the market for 400-ounce bars, and yeah, so they don't report regularly to the Bank of International Settlements, so nobody knows what they've got, and of course, for China, it's quite possible for them to buy gold through other official organisms like SAFE or the commercial banks, and not declare it. So I suspect that is the case. There is more gold there. Sorry, what was the second part of your questions?
Well, that part should have been, it was not a question, but it should have been a question. So thank you for helping me out, David. But the question really was, is this a permanent shift in global reserve dynamics that we're seeing, or is it just happening because of global, political
Yeah,
unrest?
I think it is because and I think again, there's been a lot of talk about BRICS currencies and dethroning the dollar and all that kind of stuff, and I kind of don't really subscribe to that in the short term. But it's clear that one of the strategic advantages of the US over the past 50 years is that it has had the global reserve currency. That's been an advantage geopolitically and in terms of trade. And I think over the long term, China would like to have a piece of that, right? And they've been making moves very, 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 very gradually in trying to denominate more international trade in yuan. I guess the non-convertibility or the limited convertibility, the yuan is a barrier to that. But the Chinese think in kind of 10, 20, or even 50-year lumps, right? So I think that's slow. They're slowly trying to progress that. I think the other thing in terms of China's position is that their external trade balance has just accelerated massively over the past 3 years. So they're now running record trade surpluses completely off the chart, which means that they have a lot of foreign currency coming into the system, which they need to deploy. And they're choosing not to deploy that in US treasuries, so they've got to find something to put it into, right? And I guess again, gold is the default option for them.
Does Trump change that in any way?
Does what, sorry?
Does Trump, the new president in the US, would that change the way? Well, it's going to change the way China behaves in multiple ways, I suppose. But is it going to change their liquidity inclination toward gold?
Well, I don't think so, because when you look at the development of the Chinese trade surplus, it's not with the US, right? The trade surplus is coming from exports to other emerging markets. So, it's very difficult to I think with the limited information that we have about what the tariff policy is going to be, to analyze what the impact on China-US trade is going to be. Trump's a negotiator and a deal maker, I guess, or at least he thinks he is. And I guess from the point of view of a negotiator, you always go in with an extreme position and negotiate it away in exchange for concessions from the other side. So, we'll see how this plays out. But I think it's the US is still dependent on the external world certainly for a lot of strategic materials and a lot of day-to-day consumer items. So, it's not original analysis on my part. Everybody's talked about it. The impact of a high level of tariffs on Chinese imported goods is just going to mean significant inflation in the US. So I don't know how far he's going to push this agenda. We'll see. But I don't think that affects the gold narrative that much, because China runs a trade surplus with the US, but it's growing at 2 or 3%, whereas its trade surplus with other emerging markets is growing 7 or 8% compound. So, and that's a much bigger piece of the pie for China.
Tariffs are really only one part of the promising puzzle that Trump has put forward, right? The other one is global stability improvements. I don't know if he can solve all the issues we have on a global scale. I would doubt anyone could, but if global stability improves even marginally, so could central banks quickly reduce gold purchases and kind of create, maybe even become seller of gold and create more of a supply glut, if you will?
I don't think central banks are buying gold as a hedge against geopolitical instability. I think they're buying gold because it's a much less risky asset than holding. One of the beauties of gold is there's no counterparty risk, right?
Yep.
And I think that with what happened in Russia, it it's led them to think that actually, holding that counterparty risk, which is not just a risk of that country not being able to pay the interest or the capital of the bond. It's also the fact that, now bonds are dematerialized and held on an electric register at the central bank of the country who's issued them. They can be crossed out. And, because there's a bit less tension in the Middle East, or America doesn't put as big a tariffs on Chinese trade as we were thinking, that doesn't change the nature of the asset, right? So I'm not sure that that's a factor, and I don't think you'll see central banks selling gold on that kind of story. I think the reason why countries reduce their reserves in gold, and you've seen that in some of the countries of the ex-Soviet Union, it's because they have some internal crisis going on. You've seen that with Turkey from time to time. They've reduced their gold holdings because they need to support the currency. You've seen not Ukraine. You've seen some of the ex-countries of the Soviet Union sell gold from time to time because they've got food shortages and they need to purchase stuff from the outside world. It's more kind of short-term necessities where they sell gold because it's the only hard currency that they've got to sell.
Why I'm trying to understand central bank gold purchases in the first place is because I had this assumption, or I have had this assumption throughout this entire year that it is central banks gold buying that's really driven the gold price up. Is that right in the first place? Like, do you think, because gold is up, what, 30-ish% this year to date now? Do you think it's central banks driving that?
I think they're a significant part of it. I think there has been purchases, as I was saying, from individuals in Asia as well, which is quite significant. We saw India substantially reduce the import tax on gold, because I think it was at 15%. They reduced it to 6%, I think, because there was a lot of gold smuggling going on to get around those import tariffs, and that. When you look at India's gold imports post that tariff reduction, they spiked very significantly. So there was some pent up kind of demand for gold there, I think. And when you look at China's the largest gold producer in the world. It's also the largest gold importer. And when you deduct known official purchases from that amount, there's a huge unexplained amount. So some of that is probably kind of hidden buying by official organisms, but a lot of it's individuals, I think. And if you're in China as an individual, you've already got a ton of real estate. You're limited in terms of how much money you can export every year. I think it's $50,000 of external investment. You're not allowed to buy Bitcoin. And so, gold is the only thing you can hold in China to hedge yourself against the devaluation of the currency, or to hedge yourself against, bad economic times. So I think, central banks have been the big driver, but I think there's been big supplemental buying by individuals.
Well, if they're a big driver of it, it might also be worth thinking about when they'll stop buying. So what do you think? What is it going to take for them to
look, I think
stop?
individual buying has slowed down with this big, rise in the gold price. Nobody likes to buy at the top. But I think it's still going to be a default allocation for a lot of Chinese households, just because of the lack of alternative in many ways.
That's one part. So the price of the metal itself is of course one part. I was also thinking about, like in that article that I mentioned, Goldman Sachs argued that the gold price can rise even if the dollar is strengthening. So the dollar is the other part of it all, right? So what I'm thinking
that correlation historically, which everybody's got in their mind, is pretty poor mathematically, right? The correlation between gold and the dollar.
Well,
we've seen periods where gold and the dollar have risen. In the 2000s, gold and dollar rose together for 2 or 3 years, right? So
that's actually where I want to go with this, because it has been, although the actual correlation when you chart it, which I know you have, is poor, the narrative behind it is not so poor. Like, as in, everyone seems to believe that that's the case. So, could breaking that narrative kind of destabilize traditional valuation models for gold and make
Well,
gold
traditional
seem
valuation models are already out of the window, right? Because
hmm,
they all run on US real yields and with an element of dollar in there. That just kind of since 2022, that's completely broken down. So that model kind of doesn't work anymore.
hmm. What does work? Because he said, I mean, nobody wants to buy
Well,
at the top.
Chinese yields, right? So the correlation has switched. Um, and that switching correlation reflects a big change in where the appetite for gold is coming from, and it's now coming from developing nations' central banks, and so Chinese interest rates are a much more important determinant of price, I think.
At a certain point, they are going to run out of space, and not physically, of course, but more like space in their reserves. Like, how much of their reserves could realistically be gold? And when they hit that, what happens? Do they plateau? Do they start selling out? Does it depend on their yields still, or
Well, look,
what would that look like?
the numbers are. I mean, the US has got like 70% of its reserves in gold. France, Germany, and Italy, it's between 60 and 70. China, officially, it's four. Sorry, five now. Um, you know, say that's massively underreported, and it's 15 or 20. Still a long way to go, right?
Yeah.
And that's I think to get up to the US level, they'd have to buy 10 years of global production, something like that. I can't remember the exact number, but I mean, it's massive, right? So, and that's why I kind of think it's a structural shift, which will, it'll take a decade or more for them to get where they want to be. And that's the kind of decision that they take, right? They're not thinking in 4-year electoral chunks. They're thinking 20, 30 years ahead when they're planning these things.
Is that where you think it could go realistically? 20%, or would they, I mean, as their economy is developing into potentially a bigger economy than most of the large economies that we know of, is the shift in the reserves also going to be as prominent? Like, are they going to go 70% gold?
I should think that, who knows? But logically, that's what their ambition should be. If they want to get to a position where, in the long, long term, where the yuan overtakes the dollar as the world's reserve currency. Because when you're the world's reserve currency, it's difficult to hold your much of your reserves in other currencies, right?
Hmm.
You've got to have some independent backing for your currency, and I think that's logically what they should be targeting. I mean, they don't talk about it, so we don't know, right? So,
Was that a hypothetical, or do you think the yuan is actually going to be the next reserve currency?
look, I think it will be, but probably not while I'm still alive, right?
Well,
Um,
how old are you? That's the important question here.
Never ask a lady her age. But like I say, you can see this with the energy transition. That's a very good example. China took a strategic decision, sometime around 2010 to massively reduce its dependence on the external world for energy, right? Because that was their major strategic vulnerability. And here we are 15 years later, and they're pushing ahead with it very aggressively. Half the car sales in China are now EVs. They're building 40 nuclear power stations. They, installed hundreds of square kilometers of solar panels. They're going for it. And those kind of decisions, it's not like the US, which thinks in 4-year chunks, right? They think in 20, 30, 40-year chunks. So, and I think that, China's already far and away the largest global manufacturing power. Um, it's gone from nowhere 3 years ago to being the world's largest auto exporter, ahead of Japan and Germany. Um, they have the capacity to change the economy in quite dynamic ways over, 10, 15-year timeframes. And I'm sure in the back of their minds, they have that ambition to become the global reserve currency, but I don't think they're expecting that to happen, next year or in the next 5 years or even in the next 10 years. So, I think it's they work kind of slowly and patiently towards long-term ambitions.
But that essentially means that what the Fed does is no longer going to matter as much as it did in 2023, 2024 type of thing.
Yeah, I think that that's right. You've obviously got a lot more active trading of gold going on in North America than you have in China, I think. A lot more speculative trading, and often those algorithms which are programmed on interest rates and whatever, they continue to have an influence on the short-term price formation, and that's what we've seen. I'm sure when Trump was elected, China wasn't selling gold, right? But CTAs were. So that kind of has an impact on the price formation in the short term. So, I think that fundamentally US interest rates are a much less important equation in determining the direction of gold. But in the short term, it's going to continue to have an impact.
Sadly, not much of that has been reflected in the miners. Central bank gold demand is supportive for the gold price, of course, but it doesn't benefit miners directly, like retail demand would, right? So where does that tie into? I mean, where does that bullishness on the underlying metal tie into your work, your funds, essentially?
Yeah. Look, I think, people love to talk about the gold mining sector, but I've done a few different sectors in my career, and it's the sector with the most price dispersion of any sector, I think, on the planet. Right? So if you just look in the GDX this year, which is 52 gold miners, producing gold miners, I think the worst performer is down 50%, and the best performer is up like 100%. Right? So you've got 150% price dispersion. And people say, oh, the gold miners have been disappointing this year. They've underperformed gold. Well, yeah, they have. But when you look at the GDX, but look at what's in the GDX. I mean, 45% of the GDX is Barrick, Newmont, Agnico, Wheaton, and Franco. Right? Those top five are 45% of the index. People complain about Nvidia's weight in the S&P, but when you look at the gold mining sector, it's kind of even more concentrated. And I think the sector has suffered because Barrick and Newmont have been conspicuously poor performers, both on the underlying development of free cash flow and on at the operational level. Franco's obviously been poor because it's been under a cloud of the Cobre Panama shutdown. And of those big five, only Wheaton and Agnico have actually outperformed, and not by a lot. Right? So I think Barrick's up 6% this year, and gold's up like 25 or something. So, but when you look at the kind of the second division of market caps, you've got some very good performances, and you've got companies that have delivered 2 or 3 times leverage to the gold price. So I think as a manager of an actively managed fund, you've got to seek out those opportunities, and in fact, in our fund, we don't own any of those top 5 companies.
What do you own? What did you make the most money on in 2024?
So we've had it's mainly been in the mid-cap space, so some of the Australians. So companies like Regius, Westgold have been pretty good. On the Canadian front, we've had big positions in Alamos, in Torex, in Kinross. US front, Kerr Mining has been a big position for us. We were big holders of Silvercrest and Gatos. So it's been those kind of, mid-cap producers which have really generated the leverage. And I don't really see that changing. I think that the gold mining industry is bizarre because in most normally constituted industries, you have the largest players have the lowest costs because they have economies of scale. And it's completely the reverse in the gold mining sector. So you look in the GDX and the guys with the highest costs are Barrick and Newmont, right? The highest costs of production per ounce, the highest all-in cost and the highest all-in sustaining costs are Barrick and Newmont. So and I think that is to some extent that's structural because there is a cost to managing complexity. So when you've got 15 mines in 12 different countries, or whatever Newmont's got now, they've made those disposals. There's a cost to managing that complexity. You've got to have 10 different legal teams, 10 different HR departments, 10 different government relations departments. It kind of multiplies. Whereas, if you've got 3 mines in Canada, that's a lot simpler, right, to manage. And you've got a lot less non-productive costs in your makeup. So yeah, there's a price to pay for that diversification of risk.
It's a very good point bringing up Silvercrest because I want to ask you about silver and we're going to get to it. That's kind of a little teaser for people listening to keep listening because we're going to talk about silver and how where do you find exposure in silver now that Silvercrest is gone and there's fewer and fewer names. So we'll get to that. But what's your largest position right now in the precious metals fund?
I think it's Alamos actually is the largest position now.
Mm-hmm. Why?
Which has done well this year. So you've got to think, is that going to carry on? I think Westgold down in Australia is the second largest position.
Okay.
And I think Kerr Mining is now our third.
Alamos, Westgold, Core Mining. That's your top 3 positions right now.
Yeah.
Okay. I want to talk about, and I appreciate you sharing the names with me directly, David. I really want to talk about how that became to be, why it came to be, and sort of talking about analyzing individual names. What does that process look like? Let's say you hear about a company, I don't know, somewhere in a cafe in Paris or whatever. You go to the office, you open up your laptop.
Everybody in Paris talks about mining.
Yeah, of course. I've been, and it's true. Absolutely. Can't get them to shut up. You try and order a crepe someplace and then they start talking about mining. But what do? I mean, you hear about a company, you go to the office, open up your laptop, you make a cup of coffee in a cup with the American flag on for some reason.
Yeah.
What do you do? What do you research?
So I think, I'm not a geologist and I'm not a mining engineer. So, I guess I picked up a little bit of bits and pieces here and there about geology and engineering, but so I guess the geology is not my first go-to. Obviously, I look at it, but it's not where I think I add a lot of value. I think to go back to what I was saying earlier about the dispersion of performance in the sector. I think that dispersion of performance is driven by a dispersion in various fundamental qualities. And I think there's jurisdiction, there's the geological quality of the asset, and there's management. And I think that management is clearly far and away the most important element in that equation. And I always say to clients, I'd rather have a mediocre asset geologically and a brilliant management team than a brilliant asset and a mediocre management team. And I think you can see that with something like G Mining, for instance, which has just finished building Panzino, which was an asset which had been around for 10 or 15 years, relatively low grade, no, certainly not a kind of tier one asset either. And but they've made a fantastic kind of cash flow machine out of it, I hope. And you can see that down in Australia as well. There are companies down there with like 1 gram open pits, who through careful management of the mining and the processing managed to make tremendous free cash flow yields. So I guess the first point of call is looking at management track records, and we do quite a lot of due diligence on that. We look at what the management team have done before, what they've delivered for shareholders in previous projects, and we talk to them a lot. So I think I've done about 600 management meetings this year, which is that's running at about 2 a day. Some of them it's at conferences where you do 10 in a day. But like every day, I'm doing 1 or 2 Zooms with management teams. So I think I guess that's the first stop. The second thing is jurisdiction. I think this year has been the year of jurisdictional kind of risk. For the last 2 years, we've had almost no exposure to Africa. Actually, we don't have any exposure to South Africa anymore. We have no exposure to any of the producers in West Africa. We have a couple of explorer developers in Ghana and Ivory Coast, but we've had no exposure to any of the guys who are involved in Mali or Burkina Faso, and that's generated. Not having those has generated a lot of alpha this year. Not owning B2, not owning Barrick, not owning Resolute. Has really been a contributor to relative performance to the GDX. So I guess that's been an important determinant this year. And on the kind of what I call the geological side, so I suppose the technical side of the resource, I think the thing we look for there is long mine life and or if there's a relatively short life, mine life extendability. And I think that one of the challenges for the industry is that because gold miners have shorter lives than any other type of commodity mine generically, there is this constant need to reinvest free cash flow in reserve replacement. And I think the longer the road that management has before they need to take those decisions, the less likely they are to make some kind of pro-cyclical investment mistake, right? As we saw in like 2011. We do like, I guess our portfolio is quite biased towards companies which have relatively long mine lives or where we can see a clear path to significant mine life extension or reserve life extension, I should say. Yeah.
How do you not being a geologist, and I'm not going to ignore your jurisdiction comment, actually, we're going to go to it, but how do you, not being a geologist, how do you differentiate between a real asset and a marketing stunt? When I say a real asset, there's plenty of assets that have a PE that maybe shows a long mine life, and the numbers have been twisted and turned in 1,000 different directions to make it look like a very good PA or a PFS or an FS or whatever it might be, where you're like, okay, this looks like it's going to work on paper, but that's oftentimes not the reality. So how do you differentiate between a marketing stunt and real geology?
Well, I think it comes, I think what I said the most important element was, is I think the management and the people are probably the most important, right? Um, because I can't go into a detailed geological model and pick holes in it, right? I mean, I have a working knowledge of some basic stuff about geology, but I'm not the guy who's going to spot the fatal flaw that nobody else has spotted, right? And I think other than listening to management, looking at their track record and their experience, and working out whether they are good judges of what they think they've got, and how much of their own kind of skin is in that decision. That's the most important element. And then we listen to other people who know a lot more than we do about geology. Right?
Also, you do actually consult with people on the geology. Like, it's
Oh,
not that you throw geology
sure.
completely out the
Yeah,
window.
for sure. Particularly with juniors.
When you look at some of the results that really have been gotten by the space, because that's really what it is about. We can talk about the bullish on gold and whatnot, but then inflation is part of that too, right? And so
Yeah.
there's cost inflation as well. You posted a wonderful chart a couple of months ago showing the all-in cost. So not the all-in sustaining cost. I know it's
All in.
oftentimes
Yeah.
actually everything. So growth capex, you say G&A, M&A, dividends, everything, versus the gold price. And then you typically see a very close correlation. Most of the times actually miners don't seem to make money. And now it's really opening up where the all-in cost, you've charted it at right below 2,000, and the gold price is clearly higher than that. Now it's with 2,700, something like that. And then you say, and I quote, as you can see, it's been a horrible business, slipping in and out of marginally positive and negative free cash flow over the past 15 years. And suddenly, boom, massive positive margin expansion. I'm not sure anyone is really getting this outside the sector specialists. In theory, the industry can now, for the first time in living memory, finance reserve replacements and a much higher return of capital to shareholders from free cash flow, unquote. Is that reflecting the positive performance in your portfolio? Like, is that the main thing that you follow, free cash flow?
Yeah, absolutely.
Yeah.
And as I said, like over the past 15 years until this year, the industry's kind of slipped in and out of free cash flow generation, and and that is kind of part of the problem with the gold mining industry, is that they have to invest a lot of the cash flow back into reserve replacement. There's not been much left for shareholders. You look typically, I mean, the gold mining industry yields 2%, and you look at BHP and Rio, they're yielding 6 or 7, and that's been a structural difference over the past couple of decades. It is a poor business, right? If you it's down there with airlines and offshore drillers. Only the difference is that when cyclical industries have a good year, you normally see a huge expansion in free cash flow generation, which enables them to pay down debt, increase dividends, do share buybacks. And the kind of quantum of the inflections in the gold mining industry have not been that big. So we've had 3% free cash flow yield years, and then the next year it's -3, then it's +2, then it's -4, then it's +5. And you add it all up and it comes to 0, right? And then suddenly we've got this inflection thanks to the gold price. And I think thanks to in part a slowing down in cost inflation. I mean, we saw a huge boom in cost inflation during COVID and the aftermath of COVID. That came back down. Costs came back down. Well, they didn't come back down at all. They stopped going up so much this year, I think. We've had some deflation in energy costs, in steel costs. In some of the inputs, we haven't had any deflation in labor costs. That's continued to be a negative factor. But costs are not going up, and they'll probably go up some more in 2025, but not nearly as much as the gold price has already gone up. So, I think Uh, the, the the market as a whole, when they look at gold miners, um, the big US funds can only really buy Barrick and Newmont. They can only really buy the top five because those are the only ones that have got the liquidity for the size of money that they need to deploy. And they look at the track record of those guys and they think, well, nothing to see here. We don't need to own this. And I think that means that there's a big expansion of free cash flow generation in the mid cap miners, which is not really observed or valued by the broader market at the moment. And maybe they'll never come around to looking at it. I don't know, but hopefully, when we get the Q4 numbers, that goes into some quant models and hopefully that'll attract a little bit of attention. And it only needs a little bit of attention from generalists to get this sector going. So, yeah.
I just want to talk about what the thing is going to be that it's going to get that attention from generalist investors. But with the miners now, on average, making money, and when I say making money, I mean free cash flow, not any of the other accounting metrics. They have a lot of cash on average. Is that going to trickle down into the juniors? Are we going to see bidding wars for the smaller companies?
Well, look, it would be nice if we did. I kind of somehow doubt it. I mean, we've had quite a bit of M&A this year, right, in the junior space. Most of the bids have been uncontested, or maybe there's a contest that we don't see, and then the winner gets announced. I think that was probably the case with Cisco Mining. It was the case with Great Bear a couple of years ago. There was a negotiation that went on, and then the winner was announced to the market. So I think there is competition for assets which have scale, which have good jurisdiction, and which are a long way down the permitting track. And although the junior space, a lot of the kind of explorers have had disappointing performances this year, you've had very good performances from the developers who are close to production, right? So from the Artemises and the Skinas and these guys, right, who are where you can start to discount production over the next either now or over the next 2 to 3 years.
Yeah,
and I think there will be competition for those assets, I guess.
That's a very good point, because I'm thinking about what's driven M&A so far, and it seems like it's been more strategic. Like some of the companies are just buying assets that make sense for their business model, not so much. It doesn't seem like they're worried or rushed to replace reserves, or worried or rushed to deploy the cash that they have right now because it might disappear. Like, so we don't have there's no frenzy, I suppose. There's no silly deals taking place, mostly strategic deals. And what I'm asking is, are we going to see a silly season? Like, are the bigger companies going to come back and just start buying, ounces in the ground en masse?
I don't think so. No, I don't think so. And I think, I think probably the industry has learned a little bit from what happened in 2011, 2012, when a lot of crazy stuff did get done. I don't sense any euphoria in the sector, right? I think the other thing is that because the costs of extraction have gone up so much, logically the value of ounces in the ground which haven't been extracted has gone down. And cost of extraction and the capex to get there have gone up so much. That means that actually, the ounces in the ground perhaps worth less, and are a riskier proposition. And I think you've only really seen M&A, which is, as you say, strategic, whereas, Gold Fields says, we want a big new mine in Canada, what are we going to buy? Or you've seen tuck-in acquisitions like, the Agnico O3 deal the other day. And these are being done at okay prices, but nothing crazy. Right?
Exactly. Yeah, that's exactly what I
And there's
was.
a lot of choice out there. I think there's like between Australia and Canada, like something like 2,000 junior companies listed, right? So, um, the idea of buying a basket, a portfolio of those seems pretty crazy to me because, you're probably only going to get a hit on 5% of them if you're lucky, and the others are just going to carry on raising more money and diluting shareholders and drilling more holes.
That right there is exactly where I was going with this, because it seems like a strategy that maybe worked last cycle is just buy cheap ounces, as in, an EV to ounces in the ground type of ratio. It's a ratio that it never really made sense to me. Um, and a lot of people are still kind of stuck to that ratio, thinking, "Oh, I can buy
Yeah,
ounces, on for $5-6 in the ground at an M&A frenzy. It's going to get bought at 150. I'm going to make whatever the delta is there," and that just doesn't
yeah.
make sense to me as a strategy. It doesn't seem like it makes sense to you either.
No, no, no. And I think we'll go through this cycle, and there'll be a lot of stuff which just never gets bought, right? So, I mean, I think there's got to be a clear path to building, and there's there's got to be. I think building the mine needs to be plan A, right? And getting bought is kind of plan B if it happens. And you look at some of the look at Silvercrest, which we were talking about earlier, right? I don't think that when they started that project, they were in the meat of the kind of exploration success that they ever thought that they would build that mine.
Mm.
Um, but the valuation got to a level where nobody was prepared to buy it, and they ended up having to build it. And that happened to Bellevue in Australia. I mean, they had no intention of building that. They were doing it for somebody to come along and buy it. But sometimes nobody buys it. It just doesn't fit into what anybody wants to do, or the valuation in the stock market gets to a level where producers think they can't create value by paying a premium and buying it and building it. And so you have to get on with it. So I think that's another important thing, particularly with relatively advanced exploration, is that you have to see a pathway to building it. You have to have a management team who are capable of, clearly they're going to be mainly geologists in an explorer, but the kind of guys who are prepared to step aside and put builders in there and get things done, and that is clearly plan A.
Mm-hmm.
Because you can't, given the odds of getting bought out pretty poor, you can't just put everything on that outside chance.
So, in summary, I think we've been talking for about an hour, actually. If I look at the clock, time flies when you're having fun.
Yeah,
Uh,
having
I still have
fun.
plenty of time. I hope you do, because I have plenty of questions.
Yeah, I
But
do.
in summary, you're bullish gold because of a shift in global reserve approach within the East, so to call it, but not only. But then when it comes down to picking stocks, you're still looking for quality. You don't expect there to be a frenzy, kind of a rising tide lifts all boats scenario, where even the boats that have holes in them are going to be lifted. You're still paying attention to management. You're paying attention to quality. What part of that? And then yes, the 300 million that we talked about at the beginning, and that's 300 million USD, about 450 Canadian. That is, um, and 2/3 of that is precious metals. Within that 2/3, how much is gold? How much is silver?
I don't know. It's a complicated calculation, isn't it? Because a lot of the silver miners are kind of half gold, and
Sure.
some of the gold miners or developers have got quite a lot of silver. I'd say it's 12 to 15%, I would say is,
Okay.
if you actually do the proper calculation, you take the gold out and you look at how much silver there actually is. Probably to the lower end of that, probably 12.
Is that a top-down bet where you're like, I'm less
No,
bullish on
not really.
silver, or it just happened?
not really. It happened because of the nature of the assets, I think.
Well, are you bullish on silver? Are you more bullish on silver than gold?
It's a complicated one. I think that I think silver's been pretty disappointing in this rally. It hasn't done what it did in, say, 2016, where it goes up, two or three times as much as gold. It's been pretty much in line. As we all know, silver's an industrial metal, essentially. 70% of it goes um, into industry in one form or another. It's often a byproduct metal. So production is not necessarily determined by the economics of silver. It's determined by the economics of gold or lead or zinc or whatever else is in the mine. It's a pretty small market with a very top heavy kind of speculative overlay through the futures, probably the most top heavy of any traded commodity. And I guess it's not a reserve asset. And so, although Russia's talked about buying silver, it's kind of the practicalities of buying silver as a reserve asset, because it's worth an 80th of what gold's worth to have the same monetary value. You have to have a lot more physical metal in terms of tonnage, right? Which means a lot more storage space and a lot more difficulty in moving it around. So I think the chances of silver becoming a reserve asset are pretty limited. So it's very different drivers. You have the industrial drivers, and you have the fact that it's not a reserve asset in practice. Well, that has been in practice in the past. It doesn't seem to be today. So I think there's this positive story about the new generation of solar panels and using 4 times as much silver as the previous generation. The market appears to be in deficit. So, I'm not bearish on silver. I'm just not quite sure why it's suddenly going to reassume its role as a kind of leveraged warrant on gold. I hope I'm wrong, but can't see really what's going to drive that. And I think the question I get most when I'm talking to clients is to do with the relationship between Bitcoin and gold, and has Bitcoin taken demand out of the gold market? I think the answer to that is no. Has it taken some demand out of the retail silver market? I think maybe that's a more pertinent question.
So you think people who would typically buy silver now might be distracted, or essentially buying Bitcoin instead?
I think to some extent, yeah, probably at the margins, that's probably a bit of a factor, actually. When I look at the kind of hard money people on Twitter, they're often pretty bullish on Bitcoin as well, right? The kind of individual type investors. So maybe difficult. Yes, it's difficult to know.
You're not starting a Bitcoin mining fund?
Not really. No, I kind of missed that boat, but yeah, we'll see.
Well, to go back to silver, though, another big narrative has been the silver squeeze, or the silver shortage with the paper silver and all that. Is that a narrative that you particularly found off?
Well, look, I think it's a reality. I mean, there's a huge volume of trading in silver. I can't remember the numbers, but it's multiples of the total global annual production of silver get traded like every week in those markets. So for sure, it has a big impact on price formation. Are the wicked banks out there suppressing the price of silver structurally? Maybe I don't know, to be honest.
But you don't particularly care about ratios. It doesn't seem to me. I mean, the argument that the ratio of gold to silver occurring in the Earth's crust is kind of an 8-to-1, but the real ratio is 100-to-1, or whatever it is, 90-to-1. You don't think that we necessarily have to go to a gold to silver ratio
I don't
of
think
that
so,
size?
because there are very different demand drivers, you know.
Hmm.
Central banks are not buying silver, industrial companies are not buying gold. I mean, there are very different supply, there's very different demand dynamics for the
Yeah.
two metals, right?
Different supply dynamics too, as you mentioned. It is a byproduct
Yeah, often.
of a lot of mines. That is the case with other precious metals too. When you say precious metals for your fund, is it strictly what people would call monetary metals, so gold and silver, or is there platinum and palladium in there as well?
But at the moment, we don't have any exposure to platinum and palladium. Um, that's that's partly structural, because as this is a little bit technical, but we're mutual. Our funds are mutual funds, um, and under the Article 8 of the kind of EU fund regulation, there are certain countries which are excluded from what you can actually own. And at the moment, South Africa is on a money laundering grey list, which means we're not allowed to own companies which are domiciled in South Africa. Um, and that means that it's very difficult to get an exposure to PGMs, even if you want to, right? Because the big producers are the South Africans and Norilsk, and we can't own any of those, right?
Mm.
And that means that you can buy projects. So there's Generation Mining in Canada, there's Chalice in Australia. There's probably a few others I've forgotten about, but it's very difficult to have a. So if I suddenly became hugely bullish on palladium tomorrow, it would be very difficult for me to implement that strategy in the fund.
Right, right. How do you, outside of regulation, although I think regulations do play a large role in how you have to run the fund, especially as structured as a European mutual fund. I believe there's
Yeah.
size requirements as well as in, like, you cannot go 50% in one position if you wanted to tomorrow.
No, because there's another band of regulations, the UCITS regulations, which control that, which basically means you can't have more than 10% of the fund in one issuer. Um, and I think the top 10 positions in the fund can't be more than 40% of the investments. So um, it means that in practice, you have to have a portfolio, probably to be comfortable, minimum 30 positions.
Hmm.
I think we have about 55 in the fund at the moment
Wow,
positions. So,
that's a
yeah.
lot. Is that how do you think about that? I mean, doesn't that risk diluting the performance of your best pick, though? I mean, how do you avoid falling into the
Does, but
trap of
but
over
don't
diversity?
forget, like when you're in the junior space, sorry, well, not the junior space, when you're in the mid cap space, you do have a lot of kind of single asset exposure,
Hmm.
which means that you need to diversify, right? So typically, we don't have more than 5 or 6% of our assets in any single name. Um, you always get the risk of what happened, like with Torex recently, right? So where there's an accident in the mine, everybody's worried that it's going to be shut down forever. It's their only asset. Stock goes down 15%. You know, so you don't want to have 20% in an asset where an accident at a single mine can cause a huge drawdown in stock. So yeah, and we have about 80% of the fund is invested in producers and about 20% in exploration and development.
I asked you the same hypothetical question at the beginning, but if this was all your money, is that still how you would do it? Like, would you have 55 positions if there were no regulations like that applying to you?
Um, I'd probably have fewer positions.
Hmm.
Yeah, I'd
What's a
probably have.
sweet spot?
I don't know, but I think you've still got to have a big range of diversification if you're investing in this industry. I probably have 25 or 30.
Okay. It is capital dependent, though. I mean, if you're investing 300 million bucks or you're investing 100,000, that number probably changes. Right? Like,
Sure.
how would
Yeah,
you do it if you were a private investor managing, say, I don't know, $100,000?
yeah. Well, you'd probably bring it down to sort of like 8 to 10 positions, I
That's it.
guess. Yeah, yeah.
Yeah, that makes
And I think
sense.
as a private investor, particularly if it's, I mean, it's my full-time job, so I have time to kind of look at these things and follow them closely. But I guess, as a private investor, if you have a daytime job, it's difficult to follow 50 positions, right?
Yes. Yeah, 100%. It's difficult to follow 10 sometimes, I think. And I make these videos that are about this entire space, and I still have trouble following with all my position. Well, not trouble, but challenging. What are you a private investor next to running the fund? Do you deploy your capital in mining?
I'm not allowed to
Okay.
uh, under compliance, so my money's in the fund, right? So,
Right. Oh, okay. So okay, that makes sense. Yes. Yeah. Okay. Well,
so I'm not
what,
allowed to invest in mining stocks for my personal account, um,
yeah,
which means I can only invest in things I know nothing about or put the money in the fund.
that makes sense. Yeah. How do you deal with selling in the context of position sizing? I mean, if the stock runs a lot, do you have to trim it to keep it under 10%, or you're allowed to go over it sometimes?
Um, yeah, if it gets up to 10%, we have to trim it, right? We'd probably trim it before that, right? I mean, I think particularly in the exploration development kind of part of the portfolio, um, over time, you see that a lot of these stocks, they have extraordinary bursts in performance and enthusiasm and optimism when there's a fantastic drill hole or whatever, and then they kind of drip back down again, right? And everybody forgets about it, moves on to something else until the next hole. So, I mean, we do kind of play that cycle a little bit, particularly with some of the smaller positions. We tend to take profits, partial profits, into those kind of liquidity events. And yeah, I mean that's part of the thing of managing a portfolio. So it's rare that we will buy something that goes up. It's rare that we hold on to a 10 bagger all the way up, right? We'll have been selling on the way up.
And that's on the positive side, right? When you buy something and it works out, maybe it's not a 10 bagger, but it works out and you make money. What about cutting losses and cutting losers? Like when you're wrong, so we're all wrong sometimes. How do you know when to cut losses? What's kind of a sell signal where it says, okay, David, you were wrong. Get out of this, deploy the capital elsewhere.
Yeah, look, I think I think there can be various things that can happen that make us think we're wrong. It could be geological. It could be a series of disappointing drill results, which meant that the original thesis of management has kind of been disproved. Um, it could be a change in jurisdictional risk and permitting risk. Um, it could be a change of management strategy or change of management team, and we're not enthusiastic about the new guys. It could be that we realize, and this can happen in the particularly in the energy metals fund, where we've taken a view on a commodity and we come to the conclusion that we're wrong, right? Um, and that certainly happened. That certainly happened with lithium in that fund. Um, we did have in the boom years, we had 20% of the fund in lithium. I think we're at like 3 or 4 at the moment. So, it can be commodity driven as well.
Interesting. I really want to talk about that energy fund as well here in a few minutes. But
Sure.
what I'm essentially getting out of you is that it's a bottom up approach. You start management level, you look at the asset, you look at these things, you look at the cost. And one part of that is you favor low cost producers, bottom quartile, if you will, of the cost curve, as far as I
Yeah.
understand it.
Yeah.
But they're not often in tier one jurisdictions, though. I mean, so sometimes you see them being in challenging jurisdictions. So how do you weigh the trade-off between low operating cost versus a risky jurisdiction.
Yeah, no, that's a very good point. And obviously, you can get fantastic operating costs in Mali or Burkina, and in the US, you've got the highest kind of operating costs. So I think that that's kind of what's led us to have a significant exposure to Australian producers in our fund. And you can find quite low-cost producers in Australia relative to Canada. And we do kind of invest in what I call tier 2 or tier 3 jurisdictions. So we do have some exposure to places like Brazil, Mexico, where costs are lower than they are in Canada. So we have a kind of portfolio approach to it, right? We're not going to go all out for the lowest cost ones, regardless of jurisdiction, because that would have led you to owning all kinds of stuff in places where the assets have been significantly devalued. So it's a question of spreading the risk, I guess.
But most of the money is in what you would call tier 1 jurisdictions then.
Yeah. I guess Australia, Canada, US may, looking at the physical location of the mines rather than the listing exchange, probably make up between 75 to 80% of the portfolio.
Okay.
And there's 20 to 25 which are exposed to what we call tier 2 jurisdictions or tier 3 jurisdictions like Brazil, Mexico, Chile.
Is that just political stability related, or does it also have an element of ESG into it? Because sometimes what you call tier 1 jurisdictions can have very challenging ESG requirements, community, this and that, kind of also hampering growth, if you will.
Yeah. Look, we have there's a system of labeling in France and, well, in Europe in general, right? So you can apply for the ESG label of your country, which we have for both the gold and energy metals funds. And that's it's quite a constraining process. I mean, we have a guy who works full time on ESG on the two funds.
Wow.
And we get a week-long audit every year from the Ministry of Finance to check that we're doing the work. But I think ESG is obviously in emerging markets, there's a higher charge of responsibility on the company to do the right thing. In Canada, you've got a regulator and an environmental agency, who will do a lot of the work for you. Not so much if you're in an emerging market jurisdiction. You've got to rely on the company being responsible enough. And our approach to ESG is not that we think that we're helping to save the planet by encouraging companies to reduce their carbon emissions. I think that's a bit absurd. Our approach is that not adhering to some of these things is bad for shareholders. Right? And I think, environment, if you start spilling cyanide into the water table, your mine gets shut down, right? Even in an emerging market, right? It's not good. And bad for shareholders. If you don't do a decent amount of social work, if you're not sharing some of the benefits of that mine with the people around your mine, you get into trouble, right? Look at what happened to Peñasquito after Newmont took it over, right? They Goldcorp have made all kinds of promises to the local resident groups, which they haven't fulfilled, and Newmont got into a difficult negotiation with them, and you end up with the mine being blockaded and shut down and not producing for 6 months, and then you've got the cost of starting it up again. And if you don't pay attention to this social stuff, bad things happen. And then governance speaks for itself. I mean, Canada has the worst governance of any developed market and worse than many emerging markets, I think. Right? So governance is pretty important.
Very interesting that you have someone doing that full time, essentially, but it makes sense because it sooner or later, if the community is not with you, the project is not going through. It even doesn't really
Yeah.
matter at what stage it is. It could be exploration, development, or mining itself. It's just not going through. So that's yeah, that's an interesting point. What let's maybe talk about the other funds too that you have. So 2/3 is gold. The second biggest fund is what, the energy
Energy
one?
metals, yeah. Copper's very small. We only started it a few months ago. So.
Okay. So energy metals, what should I imagine? Because some might argue that copper is an energy metal because you need it to
Oh, it
transport the
is.
energy.
It is. Yeah. I mean, that's 55% of the fund is copper.
Okay. 55% is copper. What else?
So we've got quite a lot of tin. Um, we've got quite a bit of silver in there. We have some uranium exposure. And then we've got some bits and pieces of other stuff.
Okay. This might be a podcast in and of itself, but you're bringing up two things that I'm
Oh,
interested in
look,
as
we've got a
well.
bit of lithium, not much, but we've got a bit.
Yeah, you said, what did you say, 6 or 8%, something like that?
No, it's about 3 or 4 now.
Oh, 3 or 4. Okay. Tin, though, you said you have quite a lot of tin. How? I mean, there's not that many names to get exposure to tin in the first place.
Yeah, look, so we own both of them. We own AlphaMin and we own Metals X. Those are both large positions for us,
Right.
both about 5% of the fund.
Oh, each one of those is about 5% of the fund. That is actually big. Yeah. Um, okay. What uranium? How do you deal with that? I find that the pitch for a lot of uranium companies is EV to pounds in the ground, which is again, we've established you don't like that. So how do you deal with that? How do you pick uranium names?
It's really difficult. It's really difficult. And, I think that the market is very distorted. There's, there aren't clear, I can't see clear value in most of the aspiring producers. I mean, they look pretty expensive compared to other kind of industries. I think, most of them are dependent on a strengthening uranium price to justify their valuation. So it's a real head scratcher. And then, you've got the pounds in the ground story, and obviously companies like NextGen have been a kind of beneficiary of that speculation about a future rising price. And but I can't say I like any of our uranium exposure. I can't say they're companies I love, right? I just feel that I need to have an exposure to it. I do think the nuclear story is going to develop positively over the next 4 or 5 years. Hopefully what we've got will grow into the valuation that they've currently got.
Why not just have physical exposure instead of having the
Well, we do own some of the Sprott Trust as well.
okay. What I'm not going to make you give me the names of the uranium companies because you said you don't like them, so maybe that'll be unfair. Uh, but okay, so physical is part of the exposure in uranium. Is it most of it, or stocks most of it?
It's about half and half.
Okay, good. And then uranium is what? How much of the portfolio in total?
Oh, I think it's about 6%.
Okay, so 3% of the total portfolio would be physical. That makes sense. Okay,
Yeah.
good. What else did you say? I think I'm dancing around copper because copper is such a large topic. Well, first of all, I would like to believe that I didn't bore you to death here and you would want to come back and talk to me. And then if we do a second podcast, we might do just a podcast on copper itself because it's a whole nother story itself. We can talk about it for hours, I suppose.
Yeah.
But just briefly, what names? I mean, you said it's half the portfolio. How many companies and what names do you have there?
So we've got some of the we tend in our funds we tend not to own the large cap stuff, so we don't own Freeport, we don't own Antofagasta, we don't own Southern Copper, who are the three big kind of listed purish producers. There is, as there is in the gold sector, there's a big liquidity premium, and I think you see better valuation down the market cap scale. And I also think in this copper market, there's more M&A optionality, I think, in the mid cap stocks. Although there's not many of them that move the dial that much for the majors because they're not that big. Look, we own a kind of portfolio of mid cap producers, which is dominated by companies like Capstone, Hudbay, Ivanhoe, Sandfire in Australia, Metals Acquisition Corp, and we do own some of the development assets. We were big holders of Philo. Obviously, that's gone now. We just do still own some NGEX, and we own some of the emerging stuff like Faraday, and some exploration asset, earlier stage exploration stuff.
Good. A lot of questions that pop into my head based off of that again, but we'll do a separate episode on this. What is it? I'm about to let you do your thing. Maybe go to a coffee shop in Paris and hear about another company, another mining company. What hypothetically, we've been doing hypotheticals here. So hypothetically, if you were allowed, get into your head though, you had to put all the money into one commodity. What commodity do you pick for 2025 and then forward?
Yeah, I mean, I wouldn't want to do that because I don't think that the commodity space is subject to all kinds of external and internal volatility, which means that will be a crazy thing to do. And some of the things where you're clearly bullish on, where you have a high level of conviction, often they're smaller metals like tin, where there isn't the liquidity or the choice of investments to deploy that, to implement that conviction. So I think looking forward, the tin market has been disrupted for a while now. I mean, the problems in Myanmar and Indonesia have been ongoing. It hasn't had a huge impact on the tin price. We haven't had a crazy bull market due to restricted supply. I think that that may start to impact in 2025. I think the Chinese have run down their concentrate stocks. They're reprocessing some tailings now, which must be really low grade. I think that market is in a kind of tightening wedge. I think that could be a really good performer in 2025, particularly given that China dominates the tin smelting business, and we've already seen you've seen the stuff on antimony and germanium and all these kind of export restrictions. I think if they start to apply that to tungsten and tin, then that's an arm that they've got in their armory, right? Which they haven't deployed yet, which I suspect they may do. So I'm still pretty optimistic about tin, and it's a bit holistic. I think when you look at the valuation of the tin companies, they're just incredibly cheap, right? So that kind of means that you're not that nervous holding on to these things. That there's a lot of risk built into the valuations of those companies.
Cheap on what are you measuring, EV to FCF, or what are you measuring them on?
Yeah, I mean, you look at Alphamin. I mean, it's probably on 3 times EV/EBITDA. It has a 12% dividend yield. It has a debt-free balance sheet. obviously you've got the jurisdictional risk of being not only in Congo but in North Kivu, which is on the face of it not a comfortable place to operate, but they seem to manage it pretty well.
Yeah.
But from a valuation point of view, you certainly can't get much cheaper than that.
Yeah. David, this has been a very, very, very good. I think my paper is almost, I have no space no more to take notes. But this is a very good conversation. Thank you so much for being so generous with your time and with your insights. What am I forgetting to ask you though? What did you come here hoping to talk about that I failed to bring up?
Oh, I don't know. I guess we've talked about we've talked about gold, we've talked about M&A, we've talked about the other metals. I guess, as far as the energy metals kind of theme is concerned, let's face it, it's particularly the battery metals theme has been really disappointing, right? Lithium's been horrible. All lithium stocks have been horrible. Nickel's been horrible. Cobalt is left for dead. Because rare earths, incidentally, have been very poor and difficult, and that's what kind of keeps me up at night. It is, we've got very low exposure to all those or zero exposure. I guess the risk in our positioning is that, these things stage a massive recovery. Lithium is very complex and immature market, so it's very difficult to model. It's very difficult to know how that's going to develop. But I think that would be the kind of joker in the pack if there's a big rally in lithium next year. I think everybody is really, really bearish on it now, including myself. But I think that's kind of the risk. I don't know if you saw it came out this morning. Volkswagen is taking a stake in Patriot Battery Metals at a 60% premium.
That's not something we've typically seen in mining as a whole. I had it on my notes here. I didn't want to, but we can talk about that. I do want to talk about it. That's not something we've typically seen, right? Where it's vertically taking positions. What's
I've
happened?
talked about it. I think they've taken some. I think they took some positions in some nickel assets and stuff. I mean, typically then, GM has taken. Certainly been helping with the financing of Thacker Pass. So, I think it's not unprecedented. I think the thing that I'm concerned about is that battery chemistry has already changed very significantly in this cycle, right? And when stuff gets expensive, it gets substituted, and that's what happened with cobalt. And I just think that Volkswagen's clearly they've taken a long-term offtake in exchange for a premium investment in the equity. I don't know when people think that Patriot could actually start producing lithium. I guess not before 2030. My question is, what's going to be in batteries in 2035? Right? Is it still going to be lithium carbonate or hydroxide? I don't know. It's an open question. I think battery chemistry is evolving really quickly. There are kind of alternatives being developed, and I think that's a big question for me, actually, about the future of lithium as a commodity.
That's essentially what Volkswagen is saying with this bet, though, is we think that's what it's going to be.
Absolutely, yeah. It's what Rio is saying, right?
Yeah.
These guys are Rio's put a big ticket into Arcadium, but now ramping up the investment into Rincon, so they clearly believe it.
Yeah,
but these companies get things wrong sometimes as well, right? It's not just because Rio's done it or Volkswagen's done it that it's right.
They aren't doing too well from a profit perspective themselves. I mean, I try I have limited bandwidth as is. I can barely keep up with a couple of positions on my end, let alone pay attention to how much money the car makers are making. But
or losing. Yeah.
it's not great.
No, I think they've certainly. I think they've certainly missed the first phase of um, the EV revolution, if you want to call it that. I think part of the poor penetration rate of electric vehicles in Europe and the US relative to China has been the inability of domestic manufacturers to produce competitively priced, attractive product. Right? And I think they realize that, and I think Volkswagen or these other guys, they're kind of admitting that they've missed the first kind of innings, and they're now planning for the second, right? Which I think it's surprising that they've made a big bet on lithium, because what they're saying is the second generation as well of our product is going to be powered by LFP or lithium-based batteries. I guess that's a fair assumption for a range that's going to come out in 2028. I don't know if it's a fair assumption for the longer term from 2030 onwards, but we'll see.
Well, people say wealth consists not in having great possessions, but in having few wants. And one of the few wants I have is for the mining space to become a good allocator of capital. I don't know if that's not a too big of a want, but that is exactly what David's Twitter profile says. So for people listening, that's at David FI underscore, or just look up David Finch on Twitter, on X, where you can find him. Yeah. What else, David? What else here at the end?
I think we're done. I think we're good.
That's it.
Yeah.
Thank you so much for sitting down with me today.
A pleasure. Thanks very much, Antonio.